Welcome back to Talk Tickers. Today we're going deep on Star Equity Holdings, ticker STRR, specifically their Q2 2025 earnings call from August 13th. It was, well, a pretty pivotal moment for them.
It really was. This company's got a few different parts: building solutions, energy services, and an investments arm, and they've been making some big changes. Our job today is to cut through the noise, look at what management actually said, and see if this turnaround, especially with the M&A that happened right after, is, the real deal.
Yeah, this call was definitely one to watch if you follow STRR, especially given how the stock moved afterwards. It's a complex story, so let's try and boil it down. First up, the results snapshot.
Let's do it.
Okay, so Q2 performance. The headline numbers alone were pretty striking. Revenue hit $23.7 million.
Which is a massive jump, right? Up 75.8% year over year. And it didn't just nudge past expectations, it blew the street consensus away, beat it by over 35%.
Huge beat. But it wasn't just the top line, was it? The profitability was the real story here.
Exactly. That's where the inflection point really shows. Non-GAAP adjusted EPS came in at $1.86. I mean, that's just a massive surprise compared to where they were. It felt like a signal, that all the strategic shifts they've been working on finally clicked.
Right. And the underlying metrics, the margins, they tell that same story.
Oh, absolutely. Adjusted EBITDA was $7.0 million. Compare that to a $7.5 million loss same time last year. Big swing.
Wow.
And look at gross profit, up 182% year over year to $6.3 million. But here's the kicker for me: the gross margin. It expanded by 10 full percentage points.
10 points.
Yeah, from 16% last year to 26% this quarter. That's not just volume, that's a healthier business mix. It screams we're moving away from the low margin stuff.
And the market definitely noticed. Stock popped, 2.2% right after the call?
Yep, and then that led into that huge run-up, 27%, once the Hudson Global merger actually closed a bit later. Investors clearly bought into this higher profitability narrative.
Okay, so let's dig into how they achieved that. Deep dive time. Let's start with building solutions. That's the biggest piece. Includes KBS and Timber Technologies.
Right. Revenue there was up 51%, hit $20.4 million. Part of that was Timber Tech being in for the full quarter after the acquisition, but there was organic growth too.
And the key thing seems to be the future visibility, right? That backlog number jumped significantly.
Hugely. I went from $14 million last year to $25.7 million. That gives them, a lot of confidence looking out into 2025, even 2026. They're booking work well in advance.
So where's that strength coming from? How are they winning, especially against traditional stick-built construction, say, in the Northeast? That's usually tough territory.
Well, management talked about hitting on a few key points. Quality control, because it's factory built. Timing, because they're faster and less weather dependent. And interestingly, waste reduction.
Waste reduction. How so?
They even mentioned, kind of as an aside, using the scrap wood from the manufacturing process to heat their factory up in Maine.
Huh. Okay. That's pretty clever.
It sounds small, but it points to a very detail-oriented, efficiency-focused operation. They're finding margin everywhere. Plus, they noted they have some pricing flexibility because of how lumber prices fluctuate.
Got it. So building solutions. Strong backlog, winning share, efficient operations. Now let's switch gears to energy services. Alliance Drilling Tools, ADT. This one's interesting because Q2 was tough for a lot of energy service players, right?
Yeah.
Pricing pressure, rig counts down.
Exactly. That was the backdrop. So ADT puts up $3.3 million in revenue, $500,000 in adjusted EBITDA. But the really interesting comment from management was that they were actually able to, quote, gently raise prices in some cases.
Okay, hold on. How? In that environment?
Yeah, that's the question, isn't it? Their answer is strategy. They've deliberately shifted away from generic commodity drilling tools. They focus on very specific, high-demand, mission-critical tools. For the E&P companies drilling the wells, the cost of these specific tools is actually a tiny piece of the overall well cost.
Right, so if ADT has the tool you need when you need it, and it works reliably,
you're probably willing to pay a bit more for it, rather than risk downtime. They're competing on having the right inventory, high utilization, and service, not just slugging it out on price for generic stuff.
Makes sense. So same theme again, moving up the value chain to protect and expand margins.
Precisely.
All right. Deep Dive Part 2. Let's talk strategy, because Q2 wasn't just about operations. There was major corporate action happening. The Hudson Global merger was imminent.
Yeah, the call was August 13th. The shareholder vote was set for the 21st, and it closed on the 22nd. So this merger was top of mind.
And the rationale there: scale, diversification.
All of that. using tax assets, creating a bigger platform. But the most tangible thing they guided to, the thing analysts could really grab onto, was cost savings.
How much?
They flagged $2 million in expected synergies, mostly from cutting out redundant public company costs, corporate overhead, that kind of thing. And they said they expect to get that fully realized within a year.
Okay, $2 million straight to the bottom line of the combined company. Pretty quickly. That's significant.
Very significant, immediate uplift.
But we got to play devil's advocate for a second. That huge adjusted EBITDA number, the $7 million, a big chunk of that, $5.8 million, came from the investments division. And $5.5 million of that was a one-time realized gain, right? So how much of this Q2 turnaround was just, a well-timed asset sale versus sustainable operational improvement?
Fair question. You absolutely have to acknowledge that $5.5 million gain is non-recurring. If you're modeling the core operations going forward, you back that out, no question.
Okay.
However, the gain itself wasn't just luck. It was the result of exiting an investment, a company called Servatronics, which got acquired by TransDigm, and the key part was the premium.
What was the premium?
Management said it was a 300% premium over where Servatronics stock was trading right before the deal was announced.
300%, wow.
Yeah. So while the cash is a one-off, an exit like that, they called it a watershed win, it does kind of validate the whole strategy of the investments division. It shows they can identify these undervalued assets and create significant value. It lends credibility to their capital allocation skills, which is important for the combined company story.
Okay, I see the argument. It's non-recurring cash, but it proves a concept about their investment ability.
Exactly. Validates the platform.
So putting it all together, looking forward, management didn't give formal numerical guidance, right? They haven't for a while.
Correct. No hard numbers for Q3 or Q4, but they did give some pretty clear qualitative guidance, signposts, let's call them.
What were those signposts? How should we think about the next few quarters, especially with Hudson now folded in?
Okay, so for the legacy STAR segments, Building Solutions, they expect performance to be at least flat with this strong Q2 for the next few quarters. So maintaining that high level.
Okay, flat at a high level. Same for energy.
Yep. Same guidance for energy services, at least flat. So holding the line on the improvements they just showed.
And the new piece, the Hudson business, now called business services.
They believe that business is past its low point, past the trough. The expectation they set is for it to continue the trend it was already on. Sequential and year-over-year improvement in both revenue and EBITDA.
Okay, so you've got the two legacy businesses holding strong at a higher plateau, the new business improving sequentially, plus you start layering in that $2 million cost synergy.
Right. You put all that together and the narrative clearly shifts. It's not about survival or restructuring anymore. It's about execution, integration, converting that backlog, and really driving operating leverage through 2025 and into 2026.
The focus becomes scale up.
Totally.
All right, let's shift gears again. Time for our This Is Not Financial Advices segment.
Okay, but first, the big, bold disclaimer. Everything we're about to discuss is purely hypothetical, based on our interpretation of the earnings call. It's for informational and entertainment purposes only. We are not financial advisors. This is absolutely not financial advice, recommendation, or solicitation to buy or sell any security. Do your own research. Consult with a qualified professional. Okay?
Still clear.
Yeah.
Disclaimer delivered. So the pitch deck moment, if we had to construct an outrageous but, plausible trade idea based on this call, what would it be? I'm thinking high risk, high reward. My pitch, long dated, out of the money call options on the combined company.
Ooh, okay. A leverage play, definitely high risk. What's the catalyst or catalysts that make the options potentially pay off big? The market's already pricing in some of this turnaround, right? And that $2 million synergy is known.
True. The market sees the Q2 beat. It knows about the $2 million synergy target over the next year. My thesis relies on acceleration and repetition. Two things need to happen.
Okay, number one.
Catalyst one. Management beats their own timeline on the synergies. They said $2 million fully realized within a year. What if they pull it off in, say, 6 or 9 months? Suddenly you get an unexpected EPS boost sooner than modeled. A positive surprise.
Okay, accelerated synergy realization. That can definitely catch the market off guard. Plausible. What's catalyst number two?
Catalyst 2 builds on that watershed win in the investments division. Remember that 300% premium on Servatronics? My second catalyst is they do it again.
Another big investment exit.
Exactly. Or maybe a significant upward revaluation of another key holding. Something that proves Servatronics wasn't just a lucky one-off, but that their investment platform genuinely has the ability to find and unlock major value. A second big win like that.
Would really change the perception of the investment arm's contribution and the overall valuation potential.
Right, so you get the accelerated cost cuts hitting the P&L sooner than expected, plus another major validation from the investment side. In a small cap stock like this, that combination could potentially create the kind of explosive move needed to make those out-of-the-money calls pay off handsomely. High risk, requires precise timing and execution from management, but plausible.
It's definitely an outrageous but plausible scenario built directly off the commentary in the call. Requires a lot to go right, but the logic follows.
Okay, let's wrap this up.
Sounds good. So, quick recap. STRR delivered a really decisive swing back to profitability in Q2. The key was margin expansion, driven by moving to higher value offerings in both building solutions and energy services.
That building solutions backlog provides strong forward visibility, and the Hudson Global merger integration kicked off immediately with clear synergy targets.
Yep. The focus now is squarely on execution, integration speed, and proving this new level of profitability is sustainable.
Definitely. The narrative shift is stark, from restructuring to growth and scale. And maybe the final thought to leave you, the listener, with is this. We saw how they transformed energy services from commodity to critical tools, and how building solutions is taking share from traditional methods. It begs the question.
Where else in the newly combined company might they apply that same playbook?
Exactly. Which other parts of the business are ripe for that kind of high-margin strategic transformation? Where does the next margin expansion story come from within STRR? Something to watch.
Great point. Okay, that's our deep dive on Star Equity Holdings' Q2 call. Thanks for tuning in.
As always, do your own homework. We'll catch you next time on Talk Tickers.